So you're looking at a few different options to trade, and you notice there's a few choices out there and they have low premiums and they're pretty cheap to get involved in. So for you, with your smaller trading account perhaps, this looks attractive because you can actually get several options contracts. But the question for you as an options trader should be, is this a quality position to take? Because cheap is cheap for a reason. And in this video, we are going to discuss how you can use the delta of an option to help you choose which ones are quality positions and will have the best chances of success. So what is delta? Delta is a measurement of how much an option's price will move based on a dollar move in the underlying asset. So let's say the stock is trading at 50 bucks and the option has a delta of 50 cents. This means that for every $1 move in the stock, the option will move 50 cents. So let's imagine here that you bought an out-of-the-money call option on stock XYZ. The strike price was $37. The delta was 40 cents. You can see it here on this chain. So after a strong move up in the price of XYZ, you notice the delta is now at 50 cents, right? So now every dollar move up in price is going to be an additional 50-cent price increase with the option. This delta of a call option is going to increase in value as the stock moves up. It's going to decrease as the stock moves down. Put option, it's the opposite. It's going to decrease in value as the stock goes up and increase as the stock goes down. Now, options, they become more reactive to changes in stock prices as they approach the expiration date. That delta will increase or decrease at a fast rate. That's great news if you're in profit. It's great news if you're out of the money and you're getting close to being in the money. Bad news if you're out of the money and you're going in the wrong direction. So at the money options, they're going to have a delta that's close to plus minus 50 cents. So in the money options are going to have a higher delta, and that means they are going to react faster to the movement in the stock. So look at the delta prices that are highlighted here in the green section. These are in the money. So using a put option example, notice the $37 strike price has a delta of 60 cents. Well, really 6004. So every dollar move in the underlying stock, it's going to move 60 cents depending on the direction of the underlying instrument. Now, delta can also be referred to as a hedge ratio because it kind of tells you how many options contracts you're going to need to buy or sell to hedge or protect your position if you're holding the underlying asset. Now, delta, it's a useful tool for hedging, but it's important to remember that it's not a perfect measure of your risk. You have to take into account other factors like time decay and implied volatility. So you want to use delta as part of a broader hedging strategy. We're not going to talk about that in this video. But one of the features of delta is it can give you a rough indication of the probability that your option will close in the money. So if you're looking at a put option with a delta of 60, then that option has a 60% chance of being in the money at expiration. And that's what you want. So how can we use it? Well, the worst thing that you can do is to select your options based only on the price. If you want to be aggressive by trading out of the money options with cheap premiums, you are setting yourself up for the probability of a very short-lived trading career. We want the odds in our favor when we put on a trade. So although buying the basic call and put method of trading, it's not our preferred approach, we're going to talk about this using those examples. So as mentioned, at the money options have a delta around plus minus 50 cents. And I say plus or minus because it depends if we're talking about calls or puts. So to give ourselves some breathing room, we like to have the delta to be in the 60 to 65 cent range for call options, and obviously minus 60 and minus 65 for puts. So that means that we need to be a few strikes in the money. So for this example here, the underlying stock is trading above $35. And as an option buyer, we want to take a long position buying a call option because we're bullish. So the numbers that are highlighted with a green background, they're all in the money. And that means the strike price is lower than the underlying. Keep in mind that the call option gives the buyer the right to buy the underlying at the strike price. So in this example, let's say you're holding the $31 contract. You could buy this stock at the strike price of $31, sell it back to the market of $35. It's a $4 share profit. So again, remember, we want to buy the option with a delta between 60 and 65 cents. So we're going to look to buy the $34 strike price at a premium that's equal to the midpoint of the bid-ask price, right in the middle there. So around $3.60 to $3.65 or $360 per contract. So each $1 move in the underlying would be an extra increase of 62 cents or $62 for the contract. Now, there are going to be times when we have multiple strike prices hovering within that 60-65 cent range. So when that occurs, we look at open interest and volume, and we decide that way. So this is not going to be the best example. However, if faced with these two choices, we would look to the left to the open interest column. Note that $40 strike has 583 contracts open today, as opposed to 46 at 37.50. Now remember, open interest is updated once per day, so this could change tomorrow. So we would take the $40 strike, and that falls into line with us looking at options 1 to 2 strikes in the money. There's no volume comparison in this example, which means there is none traded that day. So when we use a delta between 60 and 65 cents, we've found it gives us a benefit that we can't ignore because it puts us in a really great position at a reasonable cost and a great return on the position in our favor. It also is going to offset some of the effects of time decay during the life of the contract because we are in the money. So quick summary, what's delta? Delta is a measure of the rate of change in an option's price given a dollar move in the underlying asset. How can we use it? We can determine the probability that the option is going to expire in the money. It can also be used to select options that are more likely to move in our favor, and it's going to offset the effects of time decay. Why is it important? Well, it provides traders with a way to measure the risk of an options trade. You can also use it to manage your position and adjust for changes in the underlying asset price. To keep in mind, it's a probability, not a certainty of success. Okay, delta is going to change over time. It's important to monitor it closely. Something that's showing 70% of being in the money at expiration could change to 40% the next day. We never know. So it's just one tool that you want to use when you make trading decisions, right? It's not guaranteed. And if you want to learn more about our approach to trading options, this free guide, the 8-Minute Options Trading Cookbook, one of our most popular free giveaways we've ever had when it comes to options. Thanks for watching. Make sure you hit like, subscribe. We'll talk to you soon.